Hi and welcome everyone for the next presentation. My name is Daniel Thorsson, analyst at ABG, covering IT and technology companies. The next company presenting for us is Proact with CFO Linda Hölje. So I'll let you start your presentation about Proact and I will follow up with a couple of questions in the end.
Thank you so much. Happy to be here. So I will talk about, let's see if this works. Yes. Today, an introduction to Proact, who we are, the market we're in, for those of you who may not be so familiar with us, and then I'll talk about the latest development, including financials for us. So who is Proact then? We've been around for 30 years soon and are specializing in data management. So we're not a generalist, but an IT specialist company present all over Europe, primarily the Northern Europe, focusing on primarily its larger, medium, large-sized enterprises, public agencies. We're soon at 5 billion SEK in turnover, listed on the Nasdaq Stock Exchange, and we have 1,200 talented employees that help us deliver value to our customers. Very briefly then, the key trends that we leverage when we provide our solutions to our customers. First one, of course, is the general trend of business transformation, digital transformation, which is all done through IT and where data is key. The key technology trend that we also leverage on is the use of hybrid cloud to do that. And I will talk a little bit more about what we mean with hybrid cloud and why we think we're well positioned to leverage on that trend. But generally, we see customers moving increasingly to cloud type solutions due to the increase of speed, flexibility, and availability of their data. Security, of course, becoming increasingly important with all of we see the ransomware attacks, cyber attacks we're seeing, so that we are able to ensure cybersecurity and provide services there is a key enabler for us. GDPR, of course, also key whenever you talk about data in an EU context. And then last but not least, we see increasingly how IT is helping to drive sustainability, a key enabler, and making sure that we're enabling our customers to deliver value in a sustainable way is also one of our focus areas. So our offering then, we typically visualize it like this, a wheel. We deliver it as hybrid cloud, as I said, or private cloud, on-prem, public cloud. We do it in different areas. We typically help customers advise our customers in how they can put up the most efficient architectures and structures that work for what they want to achieve. We store the data. That's our history, where we come from, providing storage solutions in different ways. We also connect the data so it can be moved to where it needs to be. And then we have the protection and security aspect of it, cybersecurity services, backup services, disaster recovery services. And then we help drive value through the data. So we make sure that the solutions we deliver to our customers are fit for purpose when it comes to AI or analytics, compute, or any types of applications. The hybrid cloud model then that we think is a key enabler and key differentiator for us. If we go a little bit more into detail on that, we can have data, of course, or the infrastructure to manage the data in 3 different places. It's in the customer data center, so on-prem. It's in one of our data centers, so it could be as a private cloud, or it's in what we call the public cloud, which we mean being these hyperscaler data centers, so the Google, Amazon, Microsoft clouds. We deliver on-prem solutions to customers, sell it. That's what we define as our systems business. For those of you who read our reports, the systems and the support and professional services around that. We can also deliver it as a managed cloud services, so a private cloud for our customers. We can deliver this from our own cloud or our own data centers as a managed cloud service. Or we can help the customer bring their data and manage it in a public cloud, which is not as easy as some may think. Typically, we see that it becomes pretty complex. Costs can increase a lot if you don't manage it in a structured way. And then the hybrid cloud then is combining it all together. And that's what we see key advantage for us, being able to provide all of these three types in any way that the customer wants. And we see that our customers like what we do. We have strong eNPS scores, 46 in our latest survey from last year. So we're very happy that we're able to deliver the value that we want. And as I said, sustainability is also a key focus area for us. Being in the data center related space, we of course work a lot with our employees, diversity, leadership skills, making sure that we provide a good workplace. We also make sure that we have a good view of our supply chains, our customer value chains. The key environmental impact we see is through our data centers, so the environmental impact there. So that's one of our key focus areas, make sure we work with renewable energy in a very energy efficient way and design services that consume as little energy as possible. Then another important part of our strategy and how we grow is through acquisitions. So we have a target where we're saying where we want to grow by about 10% annually, and roughly half of that we expect to come from acquisitions. So this is a list of our 5 latest acquisitions, where we typically focus on finding companies that help us on our strategic journey. So you will see that all of these are cloud or cloud-centric companies, typically services companies. A lot of them are either managed cloud services companies, or lately we've been acquiring consultancy companies. We see that the competence, especially when it comes to moving to the public cloud, is a really scarce resource, and acquiring these companies helps us build those competencies quickly. We can leverage that when we advise our customers how to move to the public cloud or the hybrid cloud. So using both our consultants and then having that as a step into onboarding our customers to our managed cloud services solutions. That was the quick overview of what we do and why our customers buy from us. Then a little bit of highlight on our first quarter results. So we see strong revenue growth. We had very strong revenue growth all of last year, and we see that continuing in the first quarter this year. We had 15% growth overall, grew revenues to 1.2 billion SEK. We split our business into the systems business, then that's the resale of hardware, software. That's the part of our business that's a little bit more volatile, can depend on customer buying cycles, if we get a couple of big deals in one quarter or not. Saw strong growth all of last year, continuing with a 14% growth rate this year, up to 700 million SEK. Our services revenues are typically more stable. We have 3 different services streams. We have our support services, which are tightly connected to our systems sales, one of our recurring revenue streams. Then we have professional services, so the consulting business, which helps both when it comes to advising, installation, etc., for our systems business, but also the consulting around our managed cloud services. And then last but not least, then our managed cloud services offering, which is what we see as our key growth area going forward. This is where we see the biggest market growth. And both the support and the managed cloud services were growing very quickly as well in the first quarter. Professional services, actually a little bit of an organic decline. We acquired a company, Sepago, last year, so in total also growing a lot, but we're still having a little bit of difficulties filling all of our vacancies. So we're still seeing a war of talent in here, so a little bit weaker there. But overall, very strong growth in the first quarter, both in total as well as organically. And the revenue growth then in turn led to growth in adjusted EBITDA. So grew by 8.5% to a margin of 4.7%. Whereas our profit before tax then stayed flat at 37 million SEK, where we have the impacts of increased amortizations from our acquisitions and increased interest rates that are impacting here. Then if we take a step back, then we have communicated a number of long-term targets. These are the ones you see here, and we typically track them on a 12-month rolling basis. So if we look at then in Q1, where were we on a 12-month rolling basis? The total revenue growth, we have a target of, as I said, 10%. It grew at 33%, so significantly overperforming. You can see on the right-hand graph here at the side, we have the 10-year revenue development. You'll see that in 2020, 2021, we had a little bit weaker growth, especially 21, where we had both customers delaying investment decisions as a result of COVID, late 2020, but also all into 2021. And then end of 2021, we were hit by the semiconductor delays that pushed deliveries into 2022. And then we recovered that nicely in 2022, where we've seen very good demand for all of our offerings, which we then continue seeing into the first quarter of this year. So close to 5 billion now in rolling 12 months revenues. The EBITDA margin on a 12-month rolling basis, 6.5%, so slight decline from where we were last year. And here we have a target of 8%. So this is something we're working a lot towards. And for those of you who read our quarterly report, we are in the process of initiating a cost-saving program to make sure that we recover the cost increases that we've seen and continue tracking towards that 8% margin target. Our net debt over EBITDA target is below 2. We're quite a lot below there, 0.5. So we feel that we are well positioned to continue on our acquisition strategy. We have a balance sheet that can support it. We also want to make sure that we generate good return on our capital. So our return on capital employed target is 20%. The outcome now was just about 17. So also a little bit behind the target. And the last, we have a dividend policy. We want to distribute around a third of our net income. The dividend that we just distributed was at 1.85 SEK per share, so that's 27%. So right in the middle of the dividend or policy target as well. And the graph here on the bottom, you can see our 10-year EPS development also, that we believe we have done quite well over the past 10 years, moving revenues and then profitability even more. Although key going forward here will be our margin target and how we reach that. And then the last slide. So I think I will have more time for questions. But in summary, we believe we're well positioned. We have a strong portfolio and a good position in the growing hybrid cloud market, where we believe the majority of the demand will be. We see very few customers going all the way to public cloud. They all will typically keep some things on-prem or in private clouds due to security concerns or legacy applications that don't work in the public cloud. We see that manifestation in our top-line growth that continues in Q1. And we are in particular then want to highlight our recurring revenue growth, which is our managed cloud services and support services. So our contracted revenues continue to grow both from last year, but also on an individual quarter-by-quarter basis. So also continue to grow from last quarter, 2022.
Linda. I obviously have a couple of questions. First of all, you are geographically quite spread out across Europe, with Nordics, Germany, UK, Netherlands being the largest markets. Can you share any trends you see in those markets? Are there any that is particularly strong or weak versus the others?
So we can see that if we look at the sort of short-term trends in the first quarter, we have, and also end of last year, we've been very, very strong in the Nordics, especially the systems market has been very strong there. We have had a weaker market in the UK in particular in the last quarter, although we believe that's more of a short-term issue. Then the longer-term trends we see primarily in West. We see that the transformation to cloud goes fast there. So we've seen over the past few quarters, or longer than that, couple of years maybe, that the systems market has been declining, but we've seen very good growth in the managed cloud services. So we see that continuing there. Although there's also more of a war of talent, a bit of pressure on costs as we compete for those talents or have to use external resources. And then central, I think, is somewhere in the middle, also moving towards cloud. So we see demand for that. Systems business still strong. If we look anything on the macroeconomic trends, that's in Germany, that's where we see a little bit of worries. Not specifically for our offerings or customers so far, but we see that consumer-type companies are struggling a little bit and postponing investment decisions. But just generally, we're not seeing any significant downturn in our demand. We read all about the macroeconomics, but we're not generally seeing it anywhere right now.
Interesting. And if you look at the customer types that you have the public sector across the markets, you have large enterprises and also SMBs. Do you see any trends there that have changed recently, or maybe you expect changing throughout 2023?
So we see, the public customers are always stable, and we see them continue to be stable. When we have more uncertainties in the macroeconomics, typically they still get their budgets to help the economy. So we see them continuing to be strong. We see some larger enterprises, the ones, if we have the large ones that do have their own cost-cutting initiatives, etc., will of course look over their investments and maybe slower in investment decisions. So that's one of the things that potentially would happen or could happen in a downturn scenario. And then the SMBs, I think, are very, very different, but depending on where they are, in which segments. Of course, the segments that are not doing well will also postpone, typically, in the investments.
Yeah.
And then in some cases, we will see the opposite, that they will invest in IT to become more efficient and to try to get them out of the economic situation as well.
I see. And if we look at the large enterprise customers, for example, do they see IT as an enabler to become more efficient ahead, or do they see that as an easy decision to postpone and delay investments in IT, which could hurt you negatively? How do you view that?
So it's both. So well, first of all, it's of course the data continues to increase. So when you run out of storage, or you will need to invest. Also, typically, there's a good TCO, total cost of ownership calculation, to be done once your equipment becomes too old, so you will save money from investing. So I think what we've seen historically in historical downturns is that customers continue to invest. At some point, they may slow down the decisions. They will have some sort of investment halt, or it needs to be escalated somewhere, so it sort of slows down. But they don't sort of stop investing. So typically, that's what we see.
Looking at the cloud market and the cloud trends we see, all of the public cloud vendors that you mentioned are raising prices at the moment, but their growth is slowing. So one can imagine that the implied volume is not growing as fast as historically. Does that create a situation for you that is problematic because it becomes more costly for your customers to migrate to the cloud, or does it become an opportunity for you to compete with the hybrid cloud in a better way versus the pure 100% public cloud?
I think we primarily see it as an opportunity, actually, because I think, one of the things when we help the customers move to the public cloud, one of the things we help them with is to do it in a cost-efficient way. But also our solutions become definitely more attractive when comparing to a more expensive public cloud offering.
How much of the cloud-related revenues today come from pure reselling of public space versus the hybrid or the managed service cloud that you host, which I imagine has a higher profitability at least?
So I think, we typically don't sort of purely resell public cloud. We do it in the context of a sort of a bigger managed cloud offering, because typically it's lower margin and it's not the type of value-added services that we want to provide. But it's sort of pure reselling. It's a small part of the total managed cloud service.
Okay. And then looking ahead in the coming quarters and the rest of 2023, as you said, 2021 was a tough year for you. You couldn't really deliver on the demand you had. You ended the year with a strong order book. And then 2022 was really delivering on that order book, growing a lot last year. Is there a risk that we will see negative growth this year in a few quarters, or how should we read the 2-year trend here?
Yes, so I think we don't give forecasts, of course. Our ambition is to continue growing, definitely. But as you know, when you followed us, the systems business is a little bit volatile quarter by quarter and difficult to predict. But we do expect the long-term trend of sort of even the systems business growing. So looking at the 3, 4, 5-year trend, we still expect it to grow, and we think that we had lower organic growth for a few years, and then back to positive at 2022. That overall we should be able to sort of continue growing, but not with a lot.
Yeah, and the systems business, that's around 60% of revenues today. What does it need to be for you to achieve the 8% EBITDA margin target here? I guess the profitability is higher in the service part.
It is. It is. I think we typically aim for this 50-50 split, but it's not necessary because we see it takes because we're not giving up on our systems business, so we don't want it to decline. So it'll take a little bit of time to get to 50-50, but that's our goal. And if we're there, definitely we could reach the 8% EBITDA margin target. Yeah.
Anything else to drive the margin up to the target? Anything else you need to do better in your existing business, or is it by acquiring higher margin businesses purely ahead?
No, we have the mix effect, we have the acquisition effect, and then we also believe that we can improve our services margins further, especially in the cloud services. We see scale effects. A lot of our services, we can bring on more customers to the platforms without increasing costs. And we also do run and have been for some time now, continued improvements in efficiency, automation, how to deliver sort of best in class in services that we also believe can improve margins further.
Yeah.
So that's another important part.
Okay. In Q1, as you showed us, the strong growth continued while the margin went down year over year, and you initiated kind of a cost reduction plan or strategy, but with no further details at that point in time. Is it anything else you can share with us now on where we will see that happening, to what extent, or what roles that will be affected? Anything else?
So we're in the middle of working it out, and we will present more in our second quarter report. That's when we aim to have the sort of plan finalized and starting to implementing it.
I see. And then the question on the consulting business, if we say kind of the pure professional services business, you have it related to the product reselling, obviously, but how do you find utilization today in your pure consulting business? What we hear from peers, etc., it's a little bit longer lead times to utilize consultants, especially junior ones, etc. Is it anything you see here during the spring?
In pockets, in some pockets, we're starting to see it. So it's not big enough that it's impacting our numbers to an extent, but we're seeing. So we are, and in some pockets, as we're saying, we still have issues finding enough qualified people, and we have to rely on subcontractors, which is more expensive. But in some areas, and it's especially the more junior ones. Yeah. Yes.
I see. My final question is on M&A ahead. You mentioned you have done 1 to 2 acquisitions a year. The leverage is around 0.5 times, so that's fine as well. What are you looking to acquire?
So geographically, want to find companies in the countries we're already in. We think in most countries our market share is pretty small, so there's a big opportunity to grow that and get good synergies out of that, top line and bottom line synergies. We want to buy companies that help us in our strategy. So services companies, managed cloud or consulting companies are on the top of our agenda. We want them to be profitable. We're not generally looking for restructuring candidates. And then very, very importantly, we want the culture to fit. I mean, we typically integrate the companies completely in a few years' time to get the best synergies out. And then it's really important that the culture fits. So we do quite a lot of due diligence on understanding the founders and how they've, or the owners, how they've run the company and what the culture is when we buy them.
Yeah. And can you find those targets within your targeted valuation ranges? And what is that typically you pay for a target?
So I think typically we've been historically paying around the 8 times the EBITDA or so. We get the question sometimes now if we see valuations coming down given the downturn in the market, and we're not really seeing that. We're seeing seller expectations roughly the same. So we're still maybe taking a little bit longer to agree on valuations, but we do think that there's still quite a lot of opportunities in this space. The only maybe we will have to buy smaller companies. I mean, we typically are looking for 200 to 300 million SEK revenue companies, but we've seen lately that we're also down to 100 million sometimes. Especially smaller consulting companies could be of interest in that range as well.
True. Thank you very much. That was the final question, and time
Thank
is
you.
running out.
Thank you.